Hey day traders. Confused why you keep blowing accounts while others seem to print profits? Here's a lesson straight from a professional trader. And it might sting a little, but stick with me, because this tutorial will change how you see the markets forever. Have you ever felt like the market was hunting your stop loss? It's a common, frustrating experience for many new traders. Like, the second you place a trade, price moves exactly the other way, hitting your stop before reversing back in your original direction. You're not crazy, and you're certainly not unlucky. This isn't random chance working against you. You might just be trading like dumb money, and the market, specifically the smart money, absolutely loves dumb money. In today's tutorial, I'm going to expose what dumb money actually means in the context of trading. We'll break down the behaviors that lead to consistent losses. More importantly, I'll show you how to flip the script and start thinking like smart money. By the end, you'll have a clear roadmap to transform your trading approach and see your trades in a whole new light. Let me tell you a quick story, a personal experience that taught me one of my most valuable trading lessons. Years ago, I was trading Forex on a Friday afternoon, arguably the worst possible time to make impulsive decisions. The market was thin, and volatility could be unpredictable. The EU-USD currency pair had just made a massive, aggressive spike upwards. My heart started pounding, and I felt this overwhelming gut urge to jump in. There was no confirmation from my usual indicators, no alignment with my trading plan. It was just pure, unadulterated fear of missing out, or FOMO. I clicked the buy button, convinced I was catching the next big move. Guess what happened next? Almost immediately, the market reversed sharply. It slammed through my stop loss and then continued its downward trajectory. It felt incredibly personal, like the market knew exactly where I was and targeted me specifically. But it wasn't personal at all. It was purely mathematical, a consequence of my emotional decision-making. Dumb money acts emotionally, driven by impulses and fear. Smart money patiently waits for liquidity, for those emotional traders to provide the fuel for their own moves, and in that moment, I had just given them mine. This painful experience became a turning point, forcing me to understand the mechanics behind market movements. Dumb money isn't about being unintelligent or lacking knowledge. It's fundamentally about behavior, specifically reactive and emotional trading behaviors that consistently lead to losses. These are the patterns that institutional traders, often referred to as smart money, exploit to their advantage. Let's break down the key characteristics of dumb money behavior. Chasing price. This is perhaps the most common mistake. Dumb money traders often jump into a trade after a significant price move has already occurred. They see a big green candle or a sharp drop and fear missing out, so they enter at an unfavorable price. This usually means buying at the top of a rally or selling at the bottom of a dip, only to see the market reverse shortly after. Emotions are powerful drivers in trading. Fear can cause traders to exit winning positions too early or hold on to losing positions for too long, hoping for a recovery. Greed can lead to over-leveraging, taking excessive risks, or entering trades without proper analysis, all in pursuit of quick, large profits. These emotions cloud judgment and lead to irrational decisions. Another mistake is trading based on social media. Many beginner traders look to social media, forums, or gurus for trading signals or advice. They follow the crowd, buying what everyone else is buying or selling what everyone else is selling, without doing their own due diligence. This herd mentality often leads them into traps, as the crowd is frequently wrong at critical turning points. This is a direct consequence of chasing price and emotional trading. When a stock or currency pair has rallied significantly, dumb money traders often perceive it as strong and buy into it, only for it to reverse. Conversely, when an asset has fallen sharply, they panic and sell, often at the absolute bottom, just before a rebound. They are consistently on the wrong side of major market turns. Dumb money. Traders often enter trades based on a hunch, a single indicator, or a perceived pattern without waiting for proper confirmation. Confirmation involves waiting for additional signals, price action, or indicator alignment to validate a trading idea. Without it, entries are speculative and have a lower probability of success. In essence, dumb money is reactive and impulsive. It provides the necessary liquidity for smart money to execute their trades. For every buyer, there must be a seller, and for every loser, there's a winner. The smart money are patient predators, waiting for these predictable dumb money behaviors to provide them with optimal entry and exit points. Let's dive deeper into 3 common dumb money mistakes and understand why they are so detrimental to your trading account. Recognizing these patterns in your own trading is the first step towards improvement. FOMO in trading. What it is? This is when you see a big, fast-moving candle and a huge green one shooting up or a massive red one plummeting, and you feel an irresistible urge to jump in. Your mind screams, "It's going to the moon!" Or, "It's crashing, I need to sell now." This is pure fear of missing out, FOMO or panic. Why it's a mistake? These aggressive moves are often engineered by larger players to grab liquidity. They might push price rapidly in one direction to trigger stop losses or entice emotional traders to enter. Once enough dumb money has piled in, providing the necessary counterparty liquidity, the smart money can then reverse the price, leaving the late entrants trapped in losing positions. You're essentially buying into a move that's already exhausted or selling into a panic that's about to reverse. How to avoid it? Patience is paramount. Never chase a fast-moving candle. If you miss the initial move, there will always be another opportunity. Wait for a pullback or consolidation. After a strong move, price often consolidates or pulls back slightly. This can offer a safer, higher probability entry point. Define your entry criteria before the move. Have a clear trading plan with specific entry conditions. If the current price action doesn't meet those conditions, stay out. Trading without a confirmation signal is another highly ranked dumb money trading mistake. What it is? This mistake involves entering a trade without waiting for clear, objective signals to validate your idea. You might enter a long trade just because it looks like it's going up, or a short trade because it feels like it's topped out. You might not wait for a candle to close, or for multiple indicators to align. Why it's a mistake? Trading without confirmation is essentially gambling. You're relying on intuition or incomplete information, which is highly unreliable in the markets. Smart money uses multiple layers of analysis, price action, volume, market structure, order flow, to confirm their biases before committing capital. Without confirmation, your trades have a significantly lower probability of success, and you expose yourself to unnecessary risk. How to avoid it? Define your confirmation signals. What specific criteria must be met before you enter a trade? This could be a specific candle pattern, a break of a key level, an indicator crossing, or a combination. Wait for candle close. Never enter a trade based on an open candle. Wait for the candle to close to confirm its true direction and strength. Use multiple forms of confirmation. Don't rely on just one signal. For example, if you're looking for a long entry, you might want to see a bullish engulfing candle and a break above a resistance level and an oversold reading on an oscillator. Herd mentality in trading is another common mistake with dumb money. What it is? This is when your trading decisions are heavily influenced by what others are saying or doing. You see a popular altcoin pumping on Twitter, or everyone in a trading group is talking about a certain stock, so you jump in blindly at the top. You might also panic sell when everyone else is panicking. Why it's a mistake? The market thrives on your overconfidence and anxiety. Social media and forums are often lagging indicators. By the time a trend is widely discussed, it's often too late to enter profitably. Smart money often uses these public sentiments to their advantage, initiating reversals when the crowd is most convinced of a particular direction. You end up buying at the peak of euphoria or selling at the depth of despair, only to ride the asset down 40% or miss a massive rebound. How to avoid it? Do your own research. Develop your own trading plan and analysis process. Don't rely on others' opinions. Be skeptical of hype. If something sounds too good to be true, it probably is. High-flying assets often crash hard. Focus on your plan, not the noise. Filter out external distractions and stick to your predefined entry and exit criteria. Your plan is your shield against emotional herd behavior. So, how do the professional traders, the smart money, approach the markets differently? It's not about having secret information, it's about a disciplined, analytical, and patient approach that systematically avoids the pitfalls of dumb money behavior. This section will serve as your guide to adopting these crucial habits. Smart money doesn't chase price. They understand that the market will eventually come to them. They identify key levels, zones of interest, and potential turning points, and then they patiently wait for price to reach those areas. They don't feel the need to be in every single move. Their philosophy is to trade high-probability setups, not constant activity. Pro tip: identify key levels. Learn to mark support and resistance zones, supply and demand areas, or institutional order blocks on your charts. Set alerts. Use price alerts to notify you when the market approaches your areas of interest, so you don't have to constantly stare at charts. Practice disciplined waiting. It's hard, but consciously resist the urge to enter trades that don't meet your criteria. The best trades often require the most patience. Smart money understands the underlying market structure. They don't just blindly follow a single indicator or a simple signal. They look for where liquidity is building, where stop losses are likely clustered, and where institutional footprints, like large volume spikes or specific candle patterns, indicate significant activity. They understand that the market moves from one pool of liquidity to another. Pro tip: learn market structure. Study concepts like higher highs. Higher lows for an uptrend, lower highs. Lower lows for downtrend, consolidation ranges, and breaks of structure. Understand liquidity. Research how stop losses and pending orders create liquidity pools that smart money targets. Explore order blocks and institutional footprints. These advanced concepts can help you identify areas where large players are likely to be active. Start with basic explanations and gradually build your understanding. This is a cornerstone of professional trading. Smart money traders have a meticulously crafted trading plan for every trade. This plan includes their entry criteria, stop-loss placement, take-profit targets, risk management rules, and even their emotional state. There are no impulsive moves, no revenge trading after a loss, and certainly no trading from their phone in the bathroom. Every action is premeditated and aligned with their strategy. Pro tip: develop a comprehensive trading plan. Document your strategy, including entry rules. What specific conditions must be met? Exit rules. Where will you place your stop loss and take profit levels? Risk management. How much capital will you risk per trade, e.g. 1 to 2% of your account? Trade management. How will you adjust your stop loss or take partial profits as the trade progresses? Stick to your plan religiously. Once you've created your plan, your job is to execute it without deviation. This removes emotion from the decision-making process. Review your plan regularly. Markets evolve, and so should your plan. Review and refine it based on your trading journal and market conditions. Smart money understands that no trade is 100% guaranteed. They think in terms of probabilities. They aim to take trades where the odds are in their favor, even if it's only slightly. They accept that losses are a part of trading and focus on their overall edge over a series of trades, rather than the outcome of any single trade. This mindset allows them to manage risk effectively and remain emotionally detached. Pro tip: embrace risk management. Understand that your stop loss is not a failure. It's a tool to manage risk and protect your capital. Focus on your edge. Your edge is what gives you a statistical advantage over time. It could be a specific setup, a unique analysis method, or a disciplined approach. Track your trades, maintain a detailed trading journal, analyze your win rate, average win, and average loss. This data will help you understand your probabilistic edge. And most importantly, smart money traders know that a significant portion, often 90% of their edge, comes from not making the common dumb money mistakes. It's not about finding the perfect indicator or the secret strategy. It's about disciplined execution, emotional control, and consistently avoiding the behaviors that lead retail traders to lose money. By simply not doing what dumb money does, you automatically put yourself in a much stronger position. Pro tip: identify your personal dumb money tendencies. What emotional mistakes do you frequently make? FOMO? Overtrading? Not using a stop loss? Create a checklist. Before every trade, run through a checklist to ensure you're not falling into any dumb money traps. Practice mindfulness. Be aware of your emotional state before and during trading. If you're feeling overly emotional, step away from the charts. Back to that painful Friday Forex trade. That was the last time I entered a position without confirmation. That single costly mistake became a catalyst for profound change in my trading journey. From that day forward, I decided to become the liquidity hunter, not the liquidity provider. I committed to understanding the market's true mechanics and aligning my actions with smart money principles. And my win rate? It didn't just improve. My confidence soared. My understanding of the market deepened significantly. This transformation happened because I stopped reacting impulsively to every market flicker and started understanding the underlying forces at play. I learned to read the market's intentions, not just its movements. This shift from reactive emotional trading to proactive analytical trading is the most crucial step any beginner can take. It's about empowering yourself with knowledge and discipline, turning potential losses into valuable lessons, and ultimately building a sustainable trading career. If this video helped flip a switch in your mindset, don't just like it, comment below with "No more dumb money." Let's make this a movement, a commitment to disciplined, intelligent trading. And if you want to go deeper into smart money trading and truly master these concepts, hit that subscribe button and ring the notification bell. Because in our next video, we're breaking down a trade from a market maker's perspective, showing you exactly how these principles are applied in real time. It will blow your mind and solidify your understanding. Watch next. Smart Money Concepts. Explained, Trade Like a Market Maker.